Welcome to another podcast of the Riffle series. The Riffle podcast series brought to you by 10 Leaves. Just 3 days ago, the Dubai Financial Services Authority published a rule tweak that completely changes how authorized firms calculate their daily capital. And, well, the deadline to weigh in is ticking fast.
Yeah, it really is a critical window right now for, anyone operating in the DIFC.
Right. We are looking at Consultation Paper number 171. This was published on March 27, 2026. And our mission for this deep dive is to figure out exactly why these adjustments matter before that public comment window closes on April 27.
Because we're looking at adjustments that directly impact the actual operational mechanics of how firms manage their balance sheets and, frankly, how they handle client cash.
Exactly. And to sort of set the tone for the operational reality we're dissecting today, consider the visual of the DFSA headquarters in Dubai. The source material actually uses it as a backdrop, and it's pretty striking.
Oh, absolutely. It's an incredible building.
Right. You have this monumental modern building constructed of heavy stone and glass. But the defining architectural feature is this massive, gravity-defying rectangular cutout right in the center of the structure.
Yeah, with those heavy-duty structural cross bracings.
Yes. Exactly. Topped with those cross bracings, standing starkly against the backdrop of the Emirates Towers, it is a highly engineered piece of architecture.
And, that structure captures the fundamental tension of financial regulation perfectly, I think.
How so?
Well, the stone represents the imposing, sort of non-negotiable foundation of the rule book, while the glass represents the absolute mandate for market transparency.
Ah, I like that. And the cross bracings.
That's the constant structural reinforcement required to keep the market stable as, financial products constantly evolve.
That's a great analogy. And I'd say that massive empty space in the middle of the building represents the room left for the industry to actually operate.
Exactly. You need that space to breathe.
Which brings us right to the core of Consultation Paper 171. The paper itself categorizes these as miscellaneous changes, which, I don't know, kind of sounds like routine administrative housekeeping.
It does sound harmless, doesn't it?
Right. But when a major financial hub alters the mathematics of how firms prove their liquidity, it sends ripples through every compliance department in the jurisdiction.
If we connect this to the bigger picture, it's crucial to understand the mechanism of a consultation paper.
Right, the why behind it all.
Yeah. Regulators like the DFSA do not govern in a vacuum. They draft rules to fortify the market, sure, but then they actively solicit feedback from the authorized firms, the applicants, the legal advisors.
The people who actually have to do the work.
Exactly. The people who have to operationalize those rules, they are asking the industry to stress test the engineering before it becomes permanent.
Okay, let's unpack this. Because today's deep dive focuses on two distinct, highly technical modules within the DFSA rulebook.
Two very different beasts, yes.
Yeah. We're looking at the PIB module, which stands for Prudential Investment, Insurance Intermediation and Banking. And we're also looking at the KIB module, the Conduct of Business.
Right, and while they govern entirely different aspects of a financial institution's daily reality, both modules are, at their core, concerned with proving that a firm is solvent, stable, and handling client assets correctly.
So where do we start?
We should start with the theoretical side of the balance sheet, which is the PIB module. The proposed changes here revolve around a framework known as the ABCR.
The Activity-Based Capital Requirement.
Exactly. This framework was actually finalized back in April 2025, and it is scheduled to go live on July 1st, 2026.
Wait, that timing right there is the first signal that something significant is happening.
Because it hasn't even launched yet.
Right, the ABCR framework has not even gone into effect. We're months away from the July 1 launch, and the DFSA is already issuing a consultation paper to alter its core mechanics.
Well, the industry feedback during the implementation build-out clearly highlighted an operational friction point.
Okay, so what's the friction?
To understand the friction, you have to look at the three primary components of the ABCR framework. First, we have KAUM,
which calculates the capital requirement for assets under management, right?
Correct. Second is KASA, the capital requirement for assets safeguarded and administered. And third is KCOH, which dictates the capital required for client orders handled.
Okay, so AUM, ASA, and COH.
It's a bit of an alphabet soup, I know.
It really is. But the original rule required firms to calculate all three of these components using daily metrics.
Every single day.
Right. Every day, a firm's compliance and accounting teams would have to crunch the numbers for total assets managed, total assets safeguarded, and the total volume of client orders handled.
Which is a massive undertaking.
Right, and Consultation Paper 171 proposes a really significant pivot here. The DFSA wants to allow firms to use monthly metrics for KAUM and KOSA while keeping KCOH strictly on a daily calculation metric.
Yeah, and the divergence in those reporting timelines reflects the very different risk profiles of the activities themselves.
Think about it like stepping on a scale to track your health metrics. Tracking KCOH, the client orders you are handling, is kind of like tracking your heart rate during a high-intensity sprint.
That's a good way to look at it.
Because trading volumes can spike massively on a Tuesday due to some macroeconomic announcement, right? And then flatline completely by Wednesday afternoon.
Oh, easily. It changes minute by minute.
Exactly. That volume fluctuates wildly depending on the hour, so you need constant daily monitoring to get an accurate picture of the acute stress on the firm's systems.
Client order handling is highly transactional. It is where the immediate execution risk lives.
Right.
If a system failure or a settlement issue occurs during a massive spike in order volume, the firm needs sufficient capital mapped to that specific daily peak to, absorb the shock.
Okay, the tracking KAUM and KASA on a daily basis is like weighing yourself every single morning when your diet and exercise routine haven't changed in a year.
You're just generating data for the sake of data.
Right. Yes, your body weight might fluctuate half a pound a day in water retention, but your month-end value is not going to deviate drastically from your daily average.
No, it won't.
So checking that metric once a month is practical. Forcing a firm to weigh its entire vault of managed assets every 24 hours just seems completely exhausting for very little informational gain.
What's fascinating here is the concept of proportionality, which the DFSA actually explicitly references in the source material.
Proportionality, meaning the punishment has to fit the crime, so to speak.
Exactly, or the effort has to fit the risk. They point back to the foundational principles of Consultation Paper Now 161. Financial regulation inherently carries a cost of compliance.
Sure.
Forcing an authorized firm to reconcile and report its total assets under management every single day places a staggering administrative burden on their operations.
I need to push back on this, though.
Okay, go ahead.
If we're talking about authorized firms in the DIFC safeguarding millions or realistically billions of dollars in client assets, waiting 30 days to calculate that capital requirement feels incredibly risky.
I can see why it looks that way on the surface.
Because if a massive market correction happens on the second day of the month and KAUM drops by 20%, the regulator is flying blind for 4 weeks. How does the DSSA justify creating a 4-week blind spot for billions in assets?
Well, it is not a blind spot. It is a smoothing of the data curve.
A smoothing of the curve.
Yes, the capital buffers built into the broader ABCR framework are already designed to absorb severe market shocks. Furthermore, you have to look at the mechanical reality of what calculating daily KAUM actually demands.
It's not just hitting refresh on a web browser.
Not at all. It is not as simple as logging into a portal and checking a fiat bank balance.
You are dealing with complex, heavily diversified portfolios.
Exactly. You are dealing with equities traded across multiple global time zones. You've got highly illiquid private equity stakes, real estate trusts, emerging market bonds.
All of which are incredibly hard to price daily.
Right. To value that entire basket of safeguarded assets every 24 hours requires massive data ingestion. It requires complex pricing algorithms and literally armies of compliance personnel manually verifying illiquid asset marks.
Oh, wow.
So the DFSA realized that the minor day-to-day market fluctuations in structural assets do not impact the firm's overall risk profile enough to justify bankrupting the compliance department with daily reporting requirements.
So the sheer cost of the daily data ingestion does not actually prevent a market crash. It just artificially inflates the cost of doing business in the jurisdiction.
That's exactly. It creates friction without adding a proportional layer of safety.
Makes sense.
By shifting KAUM and KASA to a monthly calculation, the DFSA is eliminating an enormous layer of hypothetical administrative friction.
They're being practical.
Right. They are aligning the reporting requirement with the structural reality of how long-term assets actually behave. Meanwhile, keeping the highly volatile KCOH metric on a daily leash because that is where the acute execution risk actually materializes.
Okay, that division makes complete operational sense. The DFSA is relieving the administrative burden of calculating hypothetical daily capital.
Right.
But what about the friction of handling actual physical cash? That brings us to the conduct of business module and the second major proposal in Consultation Paper 171.
Yes. the KOB module.
We are moving from the theoretical calculations of the PIB module to the hard realities of the KOB module.
And this is where things get very literal. The conduct of business module governs the daily interaction between a firm and its clients, specifically the rules surrounding the safeguarding of client assets.
And the rule book divides client assets into three distinct buckets, right? Client money, client investments, and crypto tokens.
Those are the three.
And the timeline here is what makes this deep dive so urgent. On January 1st, 2026, a new rule came into force following an earlier consultation process.
Just a few months ago.
Right. That rule mandated that all three of these asset types, fiat money, traditional investments, and crypto tokens, had to be recorded and reconciled on a trade settlement date basis.
Which was a major harmonization attempt. It was designed to unify the accounting standards across all asset classes an authorized firm might hold.
But Consultation Paper 171 proposes deleting a very specific piece of that newly minted rule.
Yes, the DFSA wants to delete CO Rule A5.11.13 effective May 1st, 2026.
And this deletion specifically carves out an exception for client money, essentially removing the requirement to reconcile fiat cash on the trade settlement date.
They are entirely decoupling fiat currency from the reconciliation timeline used for equities and digital assets.
Let's examine that timeline critically for a second. The DFSA rolled out the settlement date rule for everything on January 1st.
Right.
By March 27, they published a paper proposing to delete the client money portion of it by May 1. From an outsider's perspective, that looks like rapid backtracking.
It does seem fast.
Why roll out a comprehensive rule in January only to surgically alter it 3 months later? I mean, did the regulator fundamentally misunderstand how cash works?
Well, it is less about misunderstanding cash and more about the unintended consequences of regulatory harmonization.
Unintended consequences like what?
Harmonizing rules across diverse asset classes often creates these operational edge cases. To understand why this swift correction was necessary, we have to look at the fundamental difference between settling a security and moving physical fiat currency.
Because a trade settlement date is essentially a contractual agreement, whereas moving cash relies on actual clunky banking infrastructure.
Exactly. Think about the mechanics of a transaction. If a firm buys a block of shares or a crypto token for a client, the execution happens on a centralized exchange or a blockchain protocol.
Right. The system logs it instantly.
The trade settlement date, often T+2, meaning the trade date plus 2 days, is locked in. The system records the absolute promise of that transaction.
Okay.
So an authorized firm can easily reconcile an investment ledger or a crypto wallet based on that locked-in programmatic promise.
I promise to use the analogy of buying a house here because I think it mirrors the contractual nature of the transaction perfectly.
Let's hear it.
The day you sit down and sign the closing contract is your settlement date. The deal is finalized on paper. But scale that concept up to institutional finance. We are really talking about the friction between a T+2 clearinghouse settlement cycle and the physical reality of the SWIFT banking network.
Yes, and that is the exact friction point the January 1 rule exposed. You can reconcile a securities ledger based on a clearinghouse promise.
But you can't do that with cash.
You cannot reconcile a fiat bank account based on a promise. As the DFSA clarifies in this consultation paper, client money amounts must be reconciled upon the actual receipt of funds.
Because if a client wires $10 million to the authorized firm to fund a trade, that wire transfer has to navigate the global correspondent banking system.
It's not instant.
Right. It might get flagged for a routine anti-money laundering check in Frankfurt, or it gets delayed by a random public holiday in New York.
And so the settlement date arrives, but the physical cash has not actually hit the firm's account yet.
But under the January 1 rule, the firm was legally required to record that cash on the settlement date anyway.
Which means the firm's regulatory records would show a $10 million deposit that their actual banking portal says does not exist yet.
That creates phantom balances on the ledger.
And in the realm of financial compliance, a phantom balance is an absolute operational nightmare.
I can imagine.
A false discrepancy triggers automated liquidity alarms. It forces the firm to inject its own operational capital to cover the phantom shortfall just to remain compliant on paper.
Wait, really? They have to use their own money to cover a delayed wire?
Yes. It requires compliance officers to draft manual overrides, file discrepancy reports, and waste literally hundreds of hours chasing ghost transactions that are simply delayed in the SWIFT network.
Wow. So the January rule effectively demanded that authorized firms balance their regulatory checkbooks using fiat money that was still in transit.
Pretty much.
It forced them to treat the fragmented, messy global banking system with the same programmatic certainty as a blockchain.
And that just doesn't work. By proposing the deletion of COAB Rule A5.11.13, the DFSA is separating the physical reality of a fiat deposit from the contractual reality of a digital trade.
They're fixing the glitch.
They are mandating that client money only be reconciled upon the receipt of funds. It acknowledges the inherent friction of the correspondent banking system and eliminates a massive, unintended drain on liquidity and compliance resources.
So what does this all mean for you, the listener? We've mapped out the macro architecture of the DFSA rulebook and drilled down into the micromechanics of KAUM calculations and Swift network reconciliations.
We covered a lot of ground.
We did.
Sure.
But when you synthesize these two miscellaneous changes, what is the core narrative of Consultation Paper 171?
I'd say the narrative is one of a regulatory system actively fine-tuning its own machinery to reflect operational reality. The DFSA is dismantling hypothetical friction.
On the Prudential side, the PIB module, they are shifting the capital requirements for assets under management and safeguarded assets to a monthly metric. They are conceding that forcing firms to value illiquid, complex portfolios on a daily basis is an incredibly expensive administrative exercise that provides minimal added protection against systemic risk.
And on the conduct of business side, the COB module, they are ensuring that client money is reconciled only when it actually clears the banking system and hits the account.
Saving everyone a headache.
Exactly. They're saving compliance departments from the liquidity traps and reporting nightmares caused by chasing phantom settlement balances.
But the window to influence this fine-tuning is narrow. The DFSA has proposed these solutions, but they are actively asking the market to verify the math.
This is an active, open consultation. If you represent an authorized firm, if you are a compliance officer dealing with these ledgers, or if you are legal counsel advising entities within the DIFC.
You need to pay attention.
Yes, because these adjustments directly alter your operational burden.
And the deadline for public comment is a hard stop on April 27th, 2026.
You can submit those comments directly through the DFSA online portal. But there's a specific administrative mandate included in the source material. When you submit your feedback, you must clearly identify the organization you represent.
Oh, that's important to note.
Furthermore, the DFSA operates under a mandate of transparency. They reserve the right to publish your submitted comments on their public website.
So if your firm has granular data proving why daily KAUN calculations are unworkable, or if you have specific operational case studies regarding delayed SWIFT transfers causing phantom balances, you need to submit that data.
But do it carefully.
Right. Just be aware that your arguments may end up in the public domain unless you expressly request confidentiality at the exact moment of submission.
It reflects the transparency we discussed at the very beginning, the glass and the architecture of the building.
Full circle.
The regulator needs to see into the operations of the firms, but the public also has a right to see how the rules are being forged.
Before we wrap up this deep dive into Consultation Paper 171, we need to address the speed of this entire process.
It really is quite remarkable.
We discussed how quickly the DFSA moved to fix the settlement date rule for client money. The original rule went live on January 1st. By late March, they had already drafted and published a complex consultation paper to correct the friction it caused.
That is a highly accelerated timeline for a sovereign financial regulator.
It really is.
And it leaves us with a critical question regarding the nature of governance in modern financial hubs. When a major regulator implements a sweeping rule and within 3 months issues a public paper to correct and refine it based on the acute friction the industry experienced, is that a sign of weakness in the initial drafting of the legislation? Or is it the ultimate proof of a regulatory system that is actually listening, highly adaptable, and working exactly as it should?
That's a great point to mull over. It all comes back to the structural tension of the architecture. How rigid must the foundation be, and how quickly should the cross-bracing be allowed to flex when the market winds change? Thank you for joining us on this exploration of the DFSA rulebook. We appreciate you taking the time to navigate the mechanics of these regulatory shifts with us. Until next time, keep analyzing the architecture around you.